The British pound has inched higher, surprising many, as July's inflation data revealed the highest rise in a year and a half. But here's where it gets controversial. While inflation is ticking up, the market's expectation for when the Bank of England, BOE, will cut rates isn't rushing to adjust, signaling some serious uncertainty ahead. Recent figures show that the headline Consumer Price Index, CPI, climbed to 3.8% in July, up from 3.6% the previous month. This is significant because it's the strongest inflation reading we've seen since early 2024. Of particular note, inflation within the services sector, a key focus area for the Bank of England, accelerated from 4.7% to 5%. For those new to economic terms, the CPI measures how much the prices of a typical basket of goods and services rise over time, reflecting cost of living changes. Economists had predicted a CPI increase to 3.7%. So this slightly higher number caught market watchers by surprise. Yet the BOE had anticipated the 3.8% figure, indicating they are carefully monitoring these trends. Delving deeper, the biggest factor pushing inflation up was soaring transport costs, primarily airfares. Kirstine Kuhnby-Nielsen, a foreign exchange analyst with Danske Bank, pointed out that this was driven by a volatile airfares component, which tends to fluctuate unpredictably and is something the BOE doesn't weigh too heavily in its decision-making. This nuanced detail explains why, despite the inflation uptick, the pound strengthened only very slightly. Against the US dollar, it rose by a mere 0.1% to $1.3501, while versus the euro, it edged up 0.1% to 86.18 pence. These modest gains reflect cautious sentiment among traders who are still digesting the complex signals. Let's get to the key debate. The BOE had recently cut its bank rate, but the decision was incredibly close. 5 votes in favor, 4 against, underscoring internal divisions within the Monetary Policy Committee, MPC. Some committee members remain wary about ongoing inflation pressures, viewing them as stubborn and persistent. This split raises an important question. Should the BOE act decisively to curb inflation now, or be patient and see if current measures stabilize the economy? Market expectations for the next interest rate cut are quite laid back. Investors don't fully anticipate another 25 basis point reduction until March 2026, and the odds of seeing a cut by the end of this year are roughly even. Sanjay Raja, chief UK economist at Deutsche Bank, captures this tension well by noting the MPC seems caught between rising inflation momentum and sluggish labor market signals. This illustrates a real policy dilemma. Tightening too soon could choke economic growth, but waiting too long could let inflation get entrenched. So, what does this all mean for the average person? Higher inflation, especially in essential services like transport, can squeeze household budgets. But a cautious approach by the BOE may keep borrowing costs stable for now. However, should the central bank shift its strategy? We could see sharper changes in interest rates that affect mortgages, savings, and loans. And this is the part most people miss. While headline inflation grabs headlines, the details matter tremendously. Volatile sectors like airfares can distort the headline number, leading to debates on how aggressively monetary policy should respond. With inflation dynamics evolving and the BOE's rate path uncertain, it begs the question. Or should it focus on supporting growth and employment, even if that means inflation stays elevated longer? Share your thoughts. Do you agree with the cautious market stance, or is a bolder approach overdue?